Hi, everybody, and good morning, noon from Rye, New York. Um, Thank you all for joining us. We're very excited to have an interesting session today with BMO about running a modern family office, integrating comprehensive wealth management, direct access, and efficient investments. And I'm very happy to have our friends from BMO here from Toronto, which I will read their bios, the short version of it at least. Daniel, Jay, and Neil. Good morning, noon to you from Toronto, which we're very excited to hear how things are getting better COVID-wise in Canada, which, by the way, is a great, I guess, opportunity for me to tell everybody who's here that we will be doing beyond our Canadian online conference that we've done last year with Saputo and Desmarais, De Gaspé and Sylvan Adams and Apostolopoulos and many great families. We're doing that one again right after the summer, and in-person conferences in Vancouver, Montreal, and Toronto in November. So we're very excited. So today we have with us Daniel Stanley that would lead the discussion today. He's the director of ETFs at BMO Global Asset Management. Daniel's 20 plus years of experience in the capital market industry includes positions in sales and investment management in Toronto and New York City. During his 7 years at CIBC World Markets, he developed expertise in helping advisors use structured products and foreign exchange solutions. He managed global currency exposure at Bloomberg and previously held a role as an investment advisor at RBC, where he advised clients on security selection and portfolio management. His consultative approach to working with investors is well suited to increasing the awareness of BMO ETFs amongst institutional clients. Daniel is a CFA charter holder and holds a BA from the political science from McGill University. Jay Lakawala is the regional director for Western Canada with BMO Investorline. He has over 10 years of industry experience working with clients and industry professionals alike. Prior to working with BMO Investorline, he worked at TD Waterhouse, both in the direct investing and private client group channels. Jay is very passionate about investments, and in his current role leads a team of investment professionals who educate and support their colleagues at Bank of Montreal, as well as their clients on BMO's various digital investing platforms. The team's mission is to inspire and empower Canadians to invest smarter. Jay has an MBA from the University of Alberta and completed several courses through the Canadian Securities Institute, like Canadian Securities course, options and derivatives, and others. Here we have, last but not least, Neil Hershtakovich, Head of Investments at BMO Family Office. Neil is responsible for further development of the Canadian investment platform and delivery of an integrated North American offering for BMO Family Office and ultra high net worth clients. Prior to this, Neil was head of ultra high net worth BMO Private Wealth Canada, responsible for setting overall strategy. He joined BMO in 2011 as managing director, corporate finance, responsible for building and managing a corporate lending portfolio. As part of the Diversified Industries Group, Neil originated and structured debt financing across a range of sectors. In 2019, he moved to the commercial business into BMO Wealth Management. Prior to that, he was in London, UK, at Barclays Capital and Royal Bank of Scotland, Global Markets, and worked across foreign exchange derivatives and prime brokerage. He holds a BA in management from Liverpool, John Moores University in England. So good morning, everybody. Thank you very much for joining us today. And I will let Daniel take it from here, and we'll join you guys later on for some Q&A.
Thanks, Denny. Thanks for those introductions, and thank you all for joining us to hear our story today. Just very briefly on the BMO Financial Group, we are Canada's leading financial services companies. We're the 8th largest bank in North America by assets. And the Wall Street Journal recently ranked us in the top 15 most sustainably managed companies in the world. But today, what I want to do is I want to introduce you to the best of BMO. We've got 3 teams within the BMO Financial Group who help family offices with manage their day-to-day affairs. So what I'm going to do first, I'm going to have a Q&A session with Neil Hershkovich, who is the head of investments for the BMO Family Office team. Second, I'm going to take a little bit of time to do an overview of how family offices are using exchange-traded funds to better control things like liquidity risk, tax liabilities, currency exposures, and investing costs. And then thirdly, I'm going to have a Q&A with Jay Lakdawala from BMO Investor Line to talk a little bit about Canada's most advanced service for family offices. Just a quick heads up, if you do have any questions, please feel free to send them on the chat to Denny. If they're very pressing questions, we'll answer them immediately, or we're also going to leave some time at the end of this session to go over those questions. All right, now Neil, let's get started with you, and let's dive right into it, because I think Denny did a fantastic job summarizing our background. So Neil, tell me a little bit about your family office team and how you guys work with clients on a day-to-day basis.
Thanks, Dan, and thanks, Denny. Great to be here this morning. Yeah, so we have a sizable business in both Canada and the US. We're fully cross-border, which has evolved over many years, given our history. Our family office definition is 30 million of assets with the firm, or 100 million of net worth, including an operating business or real estate in the holdings in the portfolio. Our relationships are led by our professionals, our wealth professionals, advisors, bankers, counselors regionally to ensure that we have strong local connectivity for clients, who then have access to a broad and deep set of really quite robust institutional capabilities from across the firm, including those across our family office platform. And then also, having worked across our different businesses, I've seen that so many of our clients really appreciate that we operate at what we call an enterprise level for these families, where we're bringing the entire platform from across the firm, not just wealth. So whether it's wealth or whether it's capital markets or from our commercial related business, and families like that approach because it's really very coordinated.
Thanks, Neil. Maybe talk to us a little bit about your sense of why family offices choose to work with BMO and your team.
Yeah, so I think there's a few things, right? We've got a very long history of working with like-minded families every day, and that enables us to know how they think, know what they want, and really understand what matters to them most. And that in part then enables us to bring best-in-class thinking, how we think about things as a firm, and then how we see other families operate. And we bring that to families and family offices with idea generation, perspective and insight driven approach, sharing trends, what we see across the space from working with these families day in and day out, and then providing the access to both people across our organization as well as product as needed. As you mentioned, we have, we're the eighth largest bank by assets in North America. We've got over 200 years of history. And so when we look at our families and we run a North American cross-border business, many families at this level are also multi-jurisdictional in some respect. And so they're looking for capabilities that aren't necessarily applicable nor appropriate for the broader mass affluent and high net worth market. So things like access to alts and private markets, strategic philanthropy, cross-border access, structured credit, and other pieces. And so that benefits these families when we can bring that to the table. And then because we're well connected between our businesses of wealth, capital markets, and commercial, we're really bringing a very personal and boutique approach to our clients from within a large organization, which is also quite unique in helping our clients navigate that.
Neil, given that boutique approach, you're talking to clients, on a daily basis. What's your sense for the challenges that are facing family offices in the environment we're in?
Yeah, it's a great question. I think, families can tend to firefight and family offices can tend to firefight the immediate need, right? And one of the things that we see as one of the issues is, how do you approach all of these different pieces across the spectrum? And how do you get organized in dealing with all of these issues? So there's how to determine the priority of each, how to connect them together, And then that enables how to steward the wealth successfully rather than working in isolation across each of the different pieces. So as an example, linking the capital advisory with the overall investment strategy, and then how that links to legacy planning, family education, governance. So if you have an embedded family office, as an example, where you may be the CFO of the operating business working with the family, where do you need help? Where do you not have the necessarily the expertise in-house? And that's where we're helping many families and their single family offices. We're really set up as a multi-family office where 95% of our business is serving in families and family offices. And we're helping them with all of these issues that need to be addressed, some of which are near term, and some of which are much longer processes over a period of time. And we see a real mix, but we're working to complement where family advisors need help, or families need to lean on us as, let's say, for example, an outsourced chief investment officer to help set overall strategy. Or perhaps it's other pieces of the platform, but it's all about bringing it all together so families feel comfortable that they've got somebody helping them and navigating along the way. So they're coming to us for knowledge and expertise as a multi-family office. And because all families and family offices are different, no single family office or multi-family office is the same, we can help execute on that.
So, you know, you're the go-to person, but you're right. There is no one size fits all for these families. I'm just curious from your perspective, you know, topics of discussion. What would you say are sort of the most prevalent topics of discussion that you're having with families and family offices out there these days?
Yeah, so many prevalent issues as we think about the amount of wealth that's going to transfer over the course of the next little while. We're working with clients across all of that: structured credit, setting investment strategy, and overall investment strategy, and a coordinated approach is important. Legacy planning, family governance, next gen. All of these pieces are discussed frequently in some respect, but next gen is also a prevalent issue. And how to navigate succession, not only of the business, but how to transition and then steward wealth successfully. And I think that's a real prevalent issue that people need to tackle, but it's very qualitative, and it takes a lot of facilitation and thought process behind designing the right framework to approach these issues. And so that's something that we're helping families with on what's known as the family enterprise side. You know, how do you run the family side versus the corporate business?
That's great. Thanks, Neil. You know, one last question that I want to talk about. You guys have talked about, obviously, the number of services that you offer as a family office team at BMO. There's a number of us on this call, myself, Jay, and yourself. Talk to us a little bit about how exchange-traded funds and Jay's business, the Advice Direct business, sort of fit into your overall service model to give the audience a bit of a bird's eye view of our offering.
Yeah, sure. So at the 30 million, 100 million of net worth level, we're serving, you know, around just under 1,000 families across North America. And many families do have a self-direct aspect to their strategy, right? Whether it's through advice-led or whether it's pure self-direct. And it comes in various forms, including, you know, providing children and next gen with the opportunity to learn for themselves, by directing a pool of capital, and other aspects and forms as well. I would say the trend is that it's not the primary and standalone focus for a family office investment strategy, but it can form an element or a sleeve of the approach. And I think what's important, though, is whether it's managed, self-direct, or otherwise, we have very good options that lead with advice. And advice-led is definitely our approach, and that's what brings the value add to these families and family offices.
Perfect. Well, Neil, I really appreciate that that input on what you guys do as a family office team. Thank you very much. And again, guys, just to reinforce, you know, this bird's eye view. So Neil and his team, they oversee all of the needs of a family office. I work for BMO Exchange Traded Funds, and the ETF is just one of the many investment vehicles that that Neil and his team have access to when managing the investments of a family office. So Neil, really appreciate that. Now, I'm just going to share my screen here. Bear with me, everyone, for 1 second, and we're going to dig into the topic of exchange traded funds. And so I'm hoping you will all be able to see our screen that is up there with ETFs for family offices. What I want to do, I want to start off just by a quick introduction to the ETF business, because it's really interesting. I joined BMO ETFs back in 2012. And back in 2012, you can see from this chart on there, BMO barely had $10 billion in assets under management. I can tell you that today, BMO ETFs is the second largest ETF company in Canada. We have $80 billion in assets, and we're the largest provider of bond ETFs, factor ETFs, covered call ETFs, and as you're going to find out about very shortly, importantly, we're the largest provider of US dollar denominated ETFs in Canada. Now, what I find fascinating is that while the very first ETF in Canada, or in the world, excuse me, was developed right here in Canada, back in 1990, you can see from this screen that it's really been only the last 10 years that the ETF business has been growing as explosively as it has. And the key reasons for the growth of the ETF business is ETFs, frankly, are low cost, they're tradable, they're transparent, and they are tax effective. So they give investors like your family offices more control over things like your liquidity risk, your tax liabilities, your currency exposures, and as well the cost of investing. Now, so what today's agenda really is going to be, we're going to go over how ETFs are effective market access tools to give you control over these issues that are on the screen, things like currency, taxation, bond exposures, factor investing, investing in alternatives, and in ESG as well. Now, one of the most interesting things is, how did this all happen? And it really has to do with the unique structure of an exchange traded fund, which I've drawn out on this slide number 4 for you. The first thing that I want you to keep in mind when you're looking at this slide is that an ETF is just like any other fund in Canada. They own a basket of securities like stocks or bonds, but what makes an ETF basket unique is that, unlike a mutual fund or a pooled fund, this fund trades on a stock exchange like the TSX or the New York Stock Exchange. So while there are a lot of boxes and arrows on this diagram, I want you just to focus on the big picture. So I want you to focus on the exchange traded half of this diagram on the left-hand side, and I want you to focus on the fund half of this diagram on the right-hand side. So let's start from the right-hand side, because when a new ETF is created, the ETF provider, who could be either BMO, iShares, or Vanguard, for example, and then you have the market maker, who is typically the capital markets desk within a large financial institution. So these two groups typically work together to ensure that an ETF is liquid and trades well in its infancy. And that's what you're seeing on the right-hand side of this diagram. Now, where things get really interesting is that over time, an ETF starts to take on a life of its own. The ETF starts to trade between buyers and sellers who meet to trade on the stock exchange. And this is what you're starting to see on the left-hand side of this slide, and this is what we call the natural liquidity of an ETF. Now, what gets really interesting is the natural liquidity of an ETF, which you can typically look at that as the trading volume of the ETF, can oftentimes far exceed the trading volume of the underlying stocks. So the best example I want to give you is think of SPY, SPY. So SPY is the world's largest ETF. It is the Spider S&P 500 ETF. There are $350 billion, that's billion with a B, in assets under management in that one ETF alone. SPY typically trades about 100 million shares per day. But what's interesting is that Microsoft, which is one of the largest holdings within SPY, only averages a quarter of that, about 25 million shares per day. Now, what does this unique fact mean for you, the family office? Well, it means a couple of key things. First and foremost, it means you have anonymity. When you trade an ETF on a stock exchange, you do so as an anonymous investor, not having to notify the ETF company of your intentions. So you can see on this chart, when you're buying or selling an ETF, you're on the left-hand side of this chart. The ETF provider is on the right-hand side of this chart. Second key point is that you have more control over the investment costs because you're not paying for the upfront ETF execution and creation costs of the fund itself. I liken it to buying a used car. You're not paying for the manufacturing and marketing or the markup of that car. Someone else did that for you. You're just buying the ETF as a vehicle to access the markets. And then thirdly, you get more control over your tax bill because exchange trading means that you don't have to pay the tax on every other unit holder's trading activity like you do in a pooled or mutual fund. Now, I want to give you a bit more of a specific example here of how an ETF can be used to control your tax bill. And folks, I apologize for this very ETF ticker heavy screen, but it is important to getting a key point across here. As you are all well aware, typically wealthy families have significant US assets, and as a result, you have embedded US estate tax liabilities. Well, my team at BMO ETFs can help you manage your currency exposures, minimize your exposures to US-based assets, and minimize your US estate tax liabilities by using the ETFs that are on this slide. What you're looking at is a list of our Canadian traded, US dollar denominated ETFs that give you exposure to the US markets. It's important to understand each of these ETFs are considered Canadian domiciled trusts. They do not increase your US estate tax liability. There is no connection to the IRS. So just as a simple example, let's say you've got 10 million US dollars and you want to invest it in publicly traded large cap US stocks. You could invest that 10 million US dollars in ZSP.U. That's going to give you exposure to the S&P 500 stocks, but it is not increasing your US estate tax liability. There is no connection to the IRS because that ZSP.U and every other ETF on this slide are Canadian domiciled trusts. Okay, now, beyond giving you more control over your tax bill, like we just described, ETFs also do a fantastic job of giving you more control over the cost of investing. And, you know, while I use the analogy of buying a used car in the introduction, this is a very general example. Now I want to get a little bit more specific because ETFs can be used to access both the bond and stock markets. But if you're using an ETF to access the bond markets, it's a really good example of the cost savings that can accrue when you're using an ETF instead of using the underlying securities in that ETF. So why is that? Well, if you think about a bond, unlike a stock, the bond trades over the counter. And because it trades over the counter, if you want to trade bonds, you need to have access to a bond dealer. And that is simply going to cost you more money. But a bond ETF is a low-cost basket of diversified bonds that can be traded on an exchange, and you can use them, frankly, to build a very high-quality portfolio quickly and efficiently. So I know there's a lot of numbers on this chart as well, but if you look at this slide, and I want you to keep in mind that when you see the term spread, like you do in column number 5 and column number 6 there, keep in mind that spread is an important component of the total cost of trading and owning an ETF or a bond. Now, if you compare on this slide, for example, slide number 5, which is the underlying bond spread, that's an indication of the cost of owning the underlying bonds versus column number 6, which is titled ETF spread. That's an indication of the underlying costs of owning, trading the ETF of those bonds. And you can see that in the case of the ETF spread, ETF costs are typically either the same or lower in almost all categories. And there's really significant differences in the corporate bond and aggregate bond universe categories. And you can see I've highlighted the ones where the ETF is less expensive to trade than the underlying bonds. That is the case in 12 out of 16 categories of the categories within the BMO ETF universe that we've listed here. And another point that I want to make is this savings of using bond ETFs versus bonds themselves, this applies whether you're trading the bonds yourself or whether you have outsourced this to a third-party bond manager. the bond ETF has leveled the playing field for all investors. Okay, now, while bond ETFs have leveled the playing field in terms of investing costs, equity ETFs are really leveling the playing field in terms of one's accessibility to more sophisticated investment strategies. And one of the companies that's leading the charge in this respect is a company called MSCI. MSCI is one of the world's leading index companies. They are a partner of ours here at BMO ETFs. Now, academics have done a lot of research on how investors generate returns in excess of the market. And somewhat controversially at times, they've concluded that those markets don't come from talented stock pickers, so guys like Warren Buffett. In fact, and I'd encourage you, you know, if you Google SPIVA, S-P-I-V-A, S&P Dow Jones, every quarter and at the end of every year, what they do is they calculate the returns of active managers versus indexes. And one of the things that they found as of December 2020, according to the SPIVA report, the latest one, is that 75% of large cap fund managers underperformed the S&P 500 over a 5-year basis. If you bring that down to a 1-year basis, 60% of active fund managers underperformed the index. Again, I'd encourage you to look up this data. It gives you a sense of when and where it is best to own the index versus, say, an active manager. Now, what this research that academics have done is it shows that instead of coming from really good stock pickers, that these excess returns are actually coming from simply owning stocks with identifiable, measurable, and repeatable factors like the ones that are listed on this slide. So on the lower end of the risk scale, you've got factors like low volatility, dividend, and quality. On the higher end of the risk scale, you've got factors like size, which is really just small capitalization factor. You've got momentum, and you've got enhanced value. Those are on the higher end of the risk scale. Now, I've put this quote at the bottom, which I love, because my colleague likes to say that factors are to stock portfolios as nutrients are to food. So think of a factor. Factors are the source of returns in a portfolio, just as nutrients are the source of energy in our food. And what MSCI has done is they have proven that over long periods of time, factors explain almost all of the returns in all markets. Now, this is very academic, but what does this finding mean for you, a family office, in practice? Well, it means a couple of things. Number one, as a family office, you can now tilt your exposure to a desirable factor using an ETF. The ETF, again, is transparent. It's rules-based. It dispenses with the subjectivities of active managers, and of course, it is very low cost, typically at a fraction of the cost of active management. So, to give you a couple of specific examples of where you could use a factor ETF, suppose the source of your family wealth is technology, and you want to diversify your exposure. Well, you could consider using a low volatility or a dividend factor. These are two factors that typically don't feature technology companies very prominently. A second example that I use is suppose the source of your wealth, your family wealth, is real estate, and you want to have a liquidity sleeve either for divestments of private real estate or future investments in private real estate. Well, you could consider using our REIT ETF, ZRE, which would be a complement to your private holdings. Now, the way that we think of these factors, especially the ones like the low volatility, the dividend, and the quality that are on the lower end of the risk scale, I like to sort of think of these as core holdings. On the higher end of the risk scale, the size, the momentum, and the enhanced value, typically we like to see a lot of people use these for tactical purposes. You definitely want to have more conviction about where we are in the economic cycle and the market cycle before you decide to use a momentum or a value type ETF. The best example I can give of that is value. A wonderful example, because while value for the longest period of time has been one of the worst performing factors, value over the last 6 months has actually been the best performing factor. Value tends to do well in the early stages of an economic recovery, because it's screening for stocks that are cheap but tend to experience improving earnings and higher valuations in those early stages of an economic recovery. So again, if you're a family office and you do believe the early stages of the pandemic recovery, you could overweight a value factor in the hopes of profiting from that post-pandemic recovery, as an example of a way to use a factor exchange traded fund. Now, what's interesting is that the trend to incorporating exchange traded funds that screen stock indices for desirable characteristics has broadened to include environmental characteristics, social and governance characteristics, aka ESG characteristics. And what you'll find is that these transparent, measurable, and rules-based ETFs happen to be very, very well suited to a family office because they are simply much, much easier to implement within a family office environment. And frankly, they do an excellent job of cleansing your capital. So if you think of trying to implement a responsible investment strategy in a multi-generational family office, that can often end up grinding to a halt. Why is that? For the very simple reason that every single individual has a very different opinion of what responsible investing means to them. What a transparent, measurable, and rules-based ESG ETF does, it can solve for that problem, because when you have a rules-based ETF, you know the rules that are being used to cleanse the capital. So you can go to the family office, you can go to each generation, you can go to each individual who's a stakeholder and say, are you comfortable with the rules that are being used to cleanse our capital? If we are, we implement this solution. If not, we shut the solution down and we move on to the next one. The key point here is that it helps consensus building in a topic that is very, very difficult to achieve consensus. And I might also add that oftentimes when it comes to responsible investing, when there's no consensus, oftentimes rhetoric starts to trump that consensus. And you definitely don't want to start getting into a battle of rhetoric when it comes to issues like responsible investing. The other issue and way that these ESG ETFs can help you implement these is they can also help you measure and monitor how well you're doing at cleansing your capital. You can literally ask questions like, how much less carbon risk does our investment have versus the broad index? And this is where I want to draw your attention to the screen, specifically the data on this screen, slide number 8. It comes from our quarterly ESG report card. So this is a report card that we send out to our clients on a quarterly basis. And what it does is it demonstrates how easy it is to quantify your impact when you use an ESG ETF. So from the chart on the top left, for example, you can clearly see that if you are investing in our US ESG ETF, which is called the portfolio on the left-hand side, versus the broad index, which is called the benchmark, that there is 41% less carbon risk in the ETF that is screened for ESG factors than there is with the broad index. So you can quickly answer questions about how clean or how much are we actually cleansing our capital. Now, like our factor ETFs, we partner with MSCI and we use their ESG leaders indices. MSCI is hands down the leaders in the space. They've got decades of experience in refining their ESG methodology. They've become the industry standard. A number of global sovereign wealth funds use them, and in particular, a number of pension funds are using them or using their ESG index as policy benchmarks. And that is the sure sign that you've become the global benchmark when pension funds are starting to use your indexes as policy benchmarks. All right, now I want to close off today's discussion with the topic of alternatives. Alternatives are top of mind for everyone. They are sought after for their risk premiums and their diversification benefits. The one thing to keep in mind, though, about alternatives is they are a two-tiered investment platform, really. When you think about it, the biggest pension funds in the world have access to the first pick of the assets. The biggest pension funds have the ability and the expertise to invest directly and control the liquidity and the capacity risks that are typically associated with alternative investing. Whereas the rest of us, typically when we invest in alternatives, we do so through third-party manager. So that means we have to hire someone to do due diligence. Once you've done the due diligence, you have to hire someone to manage that. And all that comes at a cost. But probably the biggest issue is that because it's a third-party manager, you have ceded control over those really important risks like liquidity and capacity risks. And these are risks that are very, very common in the alternative investment space. What the point I want to make here is that a family office can use an ETF like the ones that are listed on this slide to try to capture similar risk premiums, similar diversification benefits from the alternative space without having those capacity constraints and those liquidity concerns. So suppose you're looking at physical real estate. Well, you could always look at something like ZRE for Canadian REITs. If the alternative is physical infrastructure, you could look at ZGI for global infrastructure exposure. If it's private equity you're looking for, you could use something like ZEM. If it's private debt, you could use ZEF or ZFH for your exposures as an alternative. All right, so guys, my goal today was really to encourage you to think about an exchange traded fund as a risk management strategy, a strategy whereby you can take back control over the liquidity risk, the tax liabilities, and the investment costs of your investing. And specifically what we looked at was how you can use ETFs to reduce your US estate tax liabilities with using our .U ETFs. We looked at how ETFs can help reduce the cost of bond portfolios by using bond ETFs. We looked at how you can give yourself more control over specific equity exposures using factor ETFs. We looked at how you can use an ESG ETF to help you increase consensus on a very thorny issue like responsible investing. And then finally, we closed off by how to use an ETF to help ease the capacity constraints and liquidity risks that are typically associated with alternative investments. That is all for me, but I do want to continue here with this theme of taking back control over the variables of the investment process, because I think it's a perfect sort of segue into talking to my next guest, Jay Lakdawala, who is a director of national sales at BMO Investor Line and BMO Nesbitt Burns. And Jay, as I mentioned at the beginning, Denny did a fantastic job of introducing you and your background. So what I'd like to do is just go right over to sort of our first question for you, and that really centers around the exponential growth that we've seen in digital investing. Certainly, it's been growing very quickly over the last couple of years. Do you want to talk to us a little bit about the stats behind that and really what is driving the growth of digital investing?
Yeah, absolutely. Hi, everyone, and hi, Dan. Thanks for hosting this, and Denny, thanks for having us. Look, I mean, that's a very timely question, Dan. We were already growing at an accelerated pace, but I think we reached a tipping point last year during the pandemic. So I'll give you some statistics. Q1 of 2020 marked the fastest growing quarter since the inception of our Advice Direct platform. This year, we've seen a 63% increase year over year in this digital advice category. In terms of what's driving that, look, Canadian investors have been telling us pre-COVID, what's keeping us from managing our portfolios online is time and capacity. With COVID, they have more time at home. And there's a lot more options online for them to get educated on, tools to support their learning. But I think what's really important is beyond that is who is driving this growth. So we see a lot of engagement from next-gen investors, Gen Z millennials, but a large driver of our growth is actually coming from the ultra-high net worth and family office investors who prefer to have control over their liquidity risk, tax liabilities, their currency exposure, and the cost of their investing.
Thanks, Jay. And maybe talk to us about why they're attracted to the Advice Direct platform. What makes it a unique platform in the Canadian marketplace?
Yeah, so on the screen you'll see on the left-hand side we have our traditional self-directed channel. The analogy I'm using here is pilot for self-direct, co-pilot for Advice Direct, and autopilot for our Smartfolio product. On the self-direct side, everyone is mostly familiar with this. It's been around for decades. If you want to manage your own portfolio online, you pay a transaction fee. You have access to a world-class platform, on-demand access to placing your trades. You can do stocks, options, bonds, GICs, a wealth of investment products. You're doing the research or managing your investments. On the other hand of the slide, you'll see Smartfolio, which is more of a hands-off approach for investors. But to answer your question about what makes Advice Direct unique is this hybrid approach where you still maintain control of your portfolio, but you get this advice and research at a very high touch that you can't find anywhere else in Canada. It's very unique to us at BMO and BMO Investor Line.
Jay, you talk about that hybrid approach. I want to sort of continue with that theme, because you mentioned that we're starting to see strong adoption of this program by ultra high net worth and single family offices with Advice Direct Premium. What are the key benefits that are resonating with this group specifically?
Yeah, so we've had a lot of interest, like I said, from the ultra high net worth and family office group. I think what resonates the most with them is, on the one hand, they're empowered to manage their own portfolio, but this Advice Direct Premium brings so much more value to them. Number one, unique content and research materials, so they can stay up to date with the latest market developments. They get dedicated advisor support, so it helps them with generating customized reporting. We get a lot of these family offices that have a higher need for reporting and tax reporting, profit loss reporting, etc. We can provide all of that through this dedicated advisor support, and they can help them navigate their portfolio and supporting their needs. Besides that, it's a terrific platform if you just want to execute your own trades. You get a lot of portfolio management tools, buy-sell recommendations on what equities, ETFs to buy and sell. And I would say the pricing model also is very, very attractive to that group.
Maybe let's talk a little bit about that. What is the pricing model? What does it include there, Jay?
Yeah, certainly. So we charge 0.75% of assets up to the first $500,000. What's important here is it's only on the first $500,000. So your fees are capped at $500,000. That's $3,750 annually for all your accounts. The more you invest or as your portfolio grows, the lower your fee gets, because that's a capped fee. So that's a very, very attractive model. And within that fee, your trades are included up to a certain number of trades. You get preferred pricing on some of our fixed income products, as well as our near cash equivalent products compared to our self-direct platform. Dedicated advisor support that I talked about earlier, personalized investment advice, the buy-sell recommendations based on your investor profile, your risk tolerance, access to financial planning experts, and of course, 24/7 monitoring of your portfolio. If people want to learn more about this too, Dan, I will just say it over here. You can contact me for a demo, because once someone sees the power of this platform live, it's usually a game changer for them, and it definitely is very, very interesting and a compelling offer.
Yeah, thanks, Jay. I can attest to that. I have been on these demos, and it is very impressive. Listen, I want to thank all the attendees for attending. Look, we brought you the best of BMO today. Just a reminder, we brought Neil Hershkovich, who's the head of investments of the BMO family office team, myself, director of BMO ETFs, to talk a little bit about exchange traded funds, and then we just spoke to Jay, who's the director of BMO Investor Line. We hope that you found this session valuable. I want to, if you have any questions, please submit those questions on the chat to Denny. Afterwards, if you want to connect with us, please feel free to reach out to Denny to connect with us directly. You can always connect with either the three of us on LinkedIn as well. So thank you, and I want to thank Neil and Jay for joining me on this, and thank you all for listening in. So Denny, I'm going to hand things over to you to see if there are any questions from the audience.
Thank you. It was brilliant to hear all of you today. And I've seen that you've some of the questions you guys had were answered privately by the team here. I guess the questions that are left here, I see most were answered. Does BMO offer cryptocurrency in the ETF platform? And what are BMO's fees for the ETF side? You may have mentioned that.
Yeah, no, I didn't mention that. So good question on the cryptocurrency. That is, so short answer, we do not have a cryptocurrency ETF. Not going to say never. They are definitely very, very popular. We have talked about it, but currently our focus is on areas like the fixed income markets, equity markets, factor ETFs, but never say never. The question about the fees, fees on our ETFs range from as low as I want to say 0.05% to up to 0.45%. And what you typically find is that the sort of the broad beta, the S&P 500s, the fixed income ETFs tend to be on the lower end of that scale. When you start getting into ETFs that do things like covered call writing, then you're sort of on the higher end of that scale at 0.45%. But again, 0.45%, I say high, that is relative. So hopefully that answered the question.
What is the fee schedule for the direct advice premium for accounts larger than 500K?
Yeah, so there is no fee after the first 500K. So the maximum fee you would ever pay is $3,750. That's it.
That's a great short and to the point answer. Will we receive the presentations? Can people approach you later to receive the actual presentations?
Absolutely, yeah.
By the way, guys, everything that you've seen here today is recorded, so everybody will be able to. We'll send you the link by tomorrow. There's an automatic system that will send it to you all tomorrow at 11 EST. So you'll be able to see all of that later on tomorrow. And all of you who couldn't be here today, that don't know that because they're not here today, will also be able to watch that thing. I would like to say that before I go to my next question, that there's always the emotional side of our seminars, which I like to deliver. And I would like to say that when we started in Canada, which is our today by far most interesting market as a conference organizer in the family office space. And we were told by actually one asset manager in Toronto that we'll never get it going because family offices in Canada are too private. And anyway, they know everybody. We said, okay, BMO was the first bank to support us. First time conference several years ago in Toronto. Easy Sharp was the keynote speaker at the Four Seasons. Easy Sharp is the founder of the Four Seasons. And we had a full house that really assured us that Canada is the place for us to be. We've done 4 conferences since in Toronto alone of 6. So just to mention that we appreciate that, and BMO has been innovative and out there, just like a young, go-getter VC firm, and not, like you would have expected sometimes banks this size. Is it open to US customers? Is the next question.
So ETFs, the ETF product, absolutely. They trade on the exchange, and any investor can buy or sell them.
Another person is asking for a copy of the presentation. And again, you will have the contact information of the team, so you can talk about it directly. Is BMO in Ireland? That's the next question. Are you guys in Ireland in any way?
I know we have a London-based office. I'm not sure about the Ireland. I'm not going to answer that. I don't know if maybe Neil knows the answer to that, but I don't know. We can find out.
Excellent information and perfect timing. Thank you, Terry. Another question about the presentations. People really like your presentations, if you haven't noticed that by now. So Michelle, again, we will connect you directly with BMO. So I'm sure they will be happy to share what they feel they can. And great, it's been Emmanuel, you want a copy of the presentations as well? Great. I wish I would have presentations that would get half of this kind of rich. So whomever built those presentations should get a bonus. I'm very happy that we've had this conversation. I will talk a little bit just in case anybody has any last question here. And before you guys would say the last, any remarks you might have, I really want to thank BMO for doing this. I'm looking forward to seeing you in person at our events after the summer. As you know, I'm sending my entire family to enjoy Europe, and I stay here alone to try to cope with 10 conferences that we're doing after the summer in the US, in the UK. Sherry Blair will be speaking there, by the way, in Canada and Israel. So hopefully we'll see BMO with us in the Canadian at the Canadian events and maybe in the US. Danny, great job. Oh, I got a good thing here as well. Send me your email to contact. Okay. So thank you guys for being here. And I would like maybe Daniel, if you have anything else you'd like to add at this point, this is the point.
No, just look, thank you all to the attendees for joining us. Reach out to Denny directly if you want to contact us, have a follow-up meeting. I would also encourage everyone to connect with Neil and Jay, myself on LinkedIn as well. And we will absolutely make sure that the presentation gets out. I'll get that to Denny and we'll make sure that everyone gets the presentation. But thank you. And Neil, thank you. And Jay, thank you for joining us.
Thank you, everyone.
Thank you again. Emmanuel, I see you'll be in Israel in August. We are nowhere during the summer. We're just working on all of our events that start September to December. And again, thank you everybody for being here. Hopefully we'll see you guys shortly in person. And yeah, we'll take it from there. So thank you very much. And we'll see you next week with our upcoming sessions next week. I believe next week we have a very interesting tech discussion coming. So thank you so much.
Thanks, Denny.
And we'll be in touch, guys. Thank you. Stay safe.
Thanks, Denny.
Thank you.
Thanks. Bye-bye.